lecture. It just to remind you what we have done yesterday. It was to focus a lot on the changes in the risk assessment, the risk recognition on the accounting, and the modelization to give you some highlight and capacity to understand what is required when you read the risk, you monitor the risk, and also to have in mind that this is a model, and model has inevitably inherently some limits. So each time you work with risk, be careful. Try to think out what could be outside of the box, but there is often something outside of the box. So we will start on when we were. We have a section which is with a couple of slides, but which is in fact quite short because it's tried to illustrate some trends that I'm sure you know about within banking sector. So I upload the Excel file which is on the bank model. It's something you have on the file section of Canvas. So I believe it's impossible to follow on the screen. So I invite you to to go directly on the Excel. So for my side, for example, I print it, and because there are a couple of columns and numbers, it seems to be very difficult to put it on the on the screen and to have to be able to read it. So if you are comfortable with, we will start in say one or 2 minutes because maybe not everybody is already in, and we will start with the case of Lehman Brothers. If you have problem, raise your hand because it will be difficult to follow without the files in front of you. Okay, so I hope it's okay. Or maybe before I start, Tram will organize you in groups for tomorrow morning. We will work on a practical case, and I open 7 groups to work on 7 cases with a maximum 5 people, and maybe 5 people is a good size for a group. So maximum and optimal number in a group to work on the cases. Tram, is that something you can organize?
Yes, Professor, I can. I will ask the student to form the groups as you said, like 5 students per group and about 7 groups, and tomorrow we can start the breakout room for them to discuss.
Okay, and I believe the cases could be done in 3 hours tomorrow, and I will be there to help. If there is a need to be a little bit beyond that limit, do you advise me to give a delay after hours, or to give an extra day, or what is the practice?
You mean for them to submit
Yeah,
their work?
because I want the groups to submit a simple PowerPoint presentation.
Mm. So let's
Normally in 3 hours it should be feasible, but in case it's a little bit hard, I'm prepared to be flexible, but I do not want to be a pain and to force people to work too much. So it's not the purpose.
okay. So I think we can leave for the student a week to finish their presentation.
But wouldn't be too much, because I do not want them to be too focused on that, because it's the purpose is not to bother them too much on the topic.
Uh,
But
um,
you believe well, but your answer is to say maybe one day or two at least will be good. Because I suppose it's difficult to coordinate, being everybody at his own place.
mm, okay. So you want them to submit a day after? You means Monday?
Or you believe a week is much better?
Yeah, I think a week will be better for them and they have time to prepare. So after tomorrow, so let's say next Sunday next week they will submit their report
Okay,
to
that
me
that
and then
would
I will
okay,
send to you.
okay, fine. That would be the deadline, but
Yeah.
the target is not to reach the deadline. It's to avoid the deadline as far as possible. So ideally, it should be Sunday end of the day, but Sunday tomorrow. But if it's not possible, it would be, yeah, because I suppose that you could have other exam and thing like that. So I do not want to. Okay, so if you have exam next week, I would prefer to say deadline is tomorrow evening, so Sunday evening, and that would be some flexibility after hours, maybe 1 hour more. But you will have a case which is feasible in 3 hours. Okay, thanks for your feedback. Thank you, Tram, for your proposal. In theory, a week could be good, but if you have exam and you have your working life, you have your daily life, so it's enough with that. Okay, so decision is Sunday, 10 October, uh, mid midnight. Okay. Yeah. Yeah. Please. There is somebody wanted to ask. There is a hand raised. No. No more. Yes. Okay, so thank you for the discussion, and now we can start on the class. So the document are this one. Those is the table, and you have Lehman Brother. Lehman Brother, that the performance before the, yeah, okay, yes, the 10 October is tomorrow. But we will have a session tomorrow together in the morning, and I will help you to build your answer to the cases and to be available. So I will present you the cases. We will discuss a little bit. You will have some support, written support on the cases. You will have the document. You will have a written support, and then I will be available for the group to share any issue, question, etc. Is that clear? Please raise your hand if it's not that clear. So some of you are writing, so I will wait till I can see your contribution, which is not the case yet. Well, I can see your point on the why not middle next week or middle of next week, because I do not want to bother you. It's a simple case, so it's not it's not a very sophisticated thing. There are Q&A, there are questions, and you should answer. So I on the experience of the past sessions, it's well on a physical with a physical class with a presence, it's quite easily done in 3 hours, 4 hours. In with the online courses. Uh, okay, then I will answer to the on the online courses. I provide a supplementary piece of information on the cases in order to help you, because online it's difficult. You don't have the same assistance than being on the within the same room with you. So that's what. Yeah, you have. Yes, you have. There is a final exam which account for 70% of the grade, and case for 30%. Is that so? I suppose that answer to your question. So I see that. Yeah. Yeah. Yes. That's correct. So it's not. It's only 1/3, even slightly less than of your grade. Yeah, I don't believe the time constraint is short, because you will have 3 hours. The class of tomorrow will be okay. The tomorrow class will be allowed to the case work. So you will be working on the cases on tomorrow morning. And on the experience of the past session, it's really not an issue. Okay, so I wait for the last comment and I close the discussion after. I see you have still a lot of questions that we'll need to, for the sake of the agenda. No, I guess thank you for your suggestion to put more to have more time. I was not again, but in each time it's a perturbation. The one thing I do recognize that it's more difficult to coordinate when you are online than physically on on the same room. That's why maybe 3 hours is a little bit more demanding. So you will have different case. So different case for each group. So you will have if there are 5 groups, you will have 5 cases. Okay. So discussion. Okay. And back to the to the class. So you have on those table, but it was an important topic to discuss. You have the financial result of Lehman Brothers, and Lehman Brothers bankrupt in September 2008, so ages ago. But here you have the performance between 2003, sorry, and 2007. You can see that the revenue massively increased. The net profit, which is on the left side of the table, moved from $1.6 billion to something slightly over $4 billion. So you see it's a massive increase. The earning per share doubled. The total assets doubled. So it was a story of a very fast growing company. You see also that 2007 was a little bit softer than before because the revenue increased a little bit less, the profit a little bit less, 5% against 24%. And also the shareholder equity increased by, say, double more or less on the period. So it looks very good. On the right side of the table, you see the third block is solvency. You see leverage, the apparent leverage, which is the total asset on equity, just computed on the number you have on the left, move from 24 to 30. It's a little bit high. You remember we talked about 10, 15, and the leverage ratio published, on which you exclude some of the assets because they are very liquid, move, say, around 15. So it's a higher border, not too high, but still. And they had no risk-weighted asset tier 1 ratio because Lehman Brothers at that time was not a bank. It was a broker-dealer. So without being a bank, they didn't have access to the Federal Reserve resources. So they needed to have a lot of cash. But look at cash. On the left side, they moved from 8 billion to 20 billion, not that much. At the same time, the trading asset, the assets they roll over, they are purchasing, selling, dealing with the client, it moved from 76 to 313. So it's a lot of movement. And guess what? How they fund that? They fund that with wholesale funding. And the wholesale funding moved from 46 to 151. And this is a model on which you are very dependent on wholesale. Obviously, they try to limit the less than 1 year component, so it's nice, but they have a very huge dependence on the market. So even if the market is prepared to lend to them, they need a lot of money in order to support their functioning. And the leverage is still quite high, and they face problem at the end of the day, because if you look at the structure of the balance sheet, which is on the right side, the section 2, the block 2, funding and liquidity, you see there is no cash, so no capacity to face problems. Remember the LCR ratio. You need cash, and today a bank like that would have much more cash. The wholesale funds on the balance sheet were quite high, 20%, and the trading assets were the overwhelming majority of the asset. So trading are very, very short. So it means that in theory they balance because they borrow over 1 year and they have short-term funds. But the one thing is that they change their mind, they change the business model, and what they were doing is to put other assets and to try to take some bet within the trading asset. Rather than trading and moving fast, they start to move slowly and to take bet and big bet on operation, which are still trading but structuring. They try to purchase assets, to tranche, to structure them, and then to resell. But that's an investment bank activity. That's not a broker-dealer. They need another funding structure. And they fail because they have a business model of broker-dealer, which is okay, But in order to fuel the growth, and because they wanted to continue to grow, and they were very successful, look at we have the evolution of the stock price at the bottom of the right section, the number 4. You saw the stock price was doubling between 2003 and 2006. It was fading then in 2007. And in 2008, the value was 1 cent. But the stock price moved from 36 to 74 because they were able to deliver huge growth, and they were growth focused. So because of that, and they change the model, they slow the asset, and because they slow those assets, they have not the right funding structure, and they bankrupt only for that. And also they bankrupt because the CEO, Richard Fuld, was a very aggressive person, and he was hated by the industry. He was so proud, so selfish in a sense, that he wanted to be bigger than Goldman Sachs, and he tried to fight with everybody. So he has a very strange and difficult personality. He was supposed to be an alpha male dominant guy. His nickname was Gorilla, so which is quite self-speaking. So that's the first I wanted to show you. The second I wanted to show you, and so it's a model, Lehman. It's possible to still have that model, and you still have broker-dealer working. But if you do an investment bank activity, you need to have another funding structure. So it's because their assets change, and they didn't change the liability. For Dexia, which is exactly the same structure, but I believe the third page, you have a company which is a very, say, good company. A priori, it's a company funding local authorities, proposing saving accounts in Belgium, local authority in Europe. So they were funding schools, public welfare, public infrastructure. So looks the specialization of the company was very, very safe, and so they could be okay. But if you look at the growth, it's also a very sharp growth. You see between 2003 and 2006, the bank doubled more or less the net profit. Top line was not growing that fast, but it was growing. The EPS was doubling till if you take 2006. And if you look at the balance sheet on the left side, you see that total asset, a little bit like Lehman, was doubling. And total assets were doubling because the loan book was doubling. So, which is one thing, but at the same time, it's not explaining everything. So it's not trading, and the missing part is something which is the fact that they were creating a bond portfolio in order to deploy more money. But you see, they had not that much deposit. So loan to deposit ratio were close to 2 times. You remember the ratio we had seen from JP Morgan 0.5, HSBC 0.7, BNP 0.9. 2 times, it's very, very aggressive. And what they were doing is to fund with wholesale funding, market funding. And you see they move market funding from 205 to 383. That's a lot of growth. And in fact, they were funding long-term activities. And you see what they have in the balance sheet was on the wholesale funding. Less than 1 year was the bulk of the market resources. So here you have from the beginning, from inception, something which is very, very strange, to have a structure on which you have long-term assets. Obviously, you have 240 of loans. The missing part is bonds, so it's not in, but maybe it's around 250. So you have long-term asset. Bonds are a priori liquid. So if you think about NSFR and the capacity to sell things, it could be okay. But at the same time, most of the resources are in fact very short term. So it means that this model is okay if you do not need to sell asset, if you have always access to the market, and if you stop the growth. But it was not the case, and they had a very good performance, a good return on equity, a good cost ratio performance, etc. But you see the tier one capital was a priori okay, around 10%, but the stock price react positively to that strategy. But when the market entered difficulties, the wholesale market closed, and because the wholesale market closed, they were unable to tap the market. And being unable to tap the market, they were unable to fund their growth. And because they didn't start the growth machine, at that time, they needed money and they had no money. So they were obliged to liquidate portfolio, and that was the beginning of the catastrophe. And they bankrupt maybe a couple of days after Lehman. I believe it was beginning of October, maybe 8, 9 of October. So, but 2008. So, couple of months after Lehman. So we have another example of unfit structure, and again here you can see that there were very little amount of cash. So those models cannot be possible. So I wanted to show that to you because these models, the weaknesses we had seen during the crisis, would not be possible now. So back to the support. The banks model, even if they were not challenged by other things than regulation, we saw the liquidity, we saw the capital, we saw the risk. So that's a challenge by, say, regulators, standard setter. At the same time, you have a big change in the economy, in the organization of the economy, which is a digitization. And the fact that everything is online, on the web, etc., and that you mean that the barriers to entry vanish in theory. And you could have a lot of new competitors, fintech, big tech, telco, etc. And that was changing a lot the banking model. But also ESG, climate is moving also the model. So if we take that example, that's a JP Morgan, how they were, and that's why that's something we could think when we were doing the example of Lehman, for example. You see, you cannot have really the same model now than in the past. You see the liquidity, the cash they have, which is the last row. The cash they have in 2008, so which is cash plus liquid asset, was multiplied by an incredible number. The CET1 also is impressively over that. So all the existing metrics show that you double or triple liquidity, you double, triple capital. So the model has nothing to do, and JP Morgan, the biggest US bank, showed that very well. And even JP Morgan, the CEO, Jamie Dimon, make an example with Lehman, and he say, what would be a Lehman today, a broker-dealer with the same characteristic of Lehman in 2007? They should have that of liquidity, that of equity, etc. Could they fail? Maybe yes, maybe no. But the current structure helped to weather the crisis. So the digital economy changed a lot the intermediation, and it changed the reserve of value. You saw the development of the crypto and many things. And also it changed something which is a key thing. It changed the way you acquire clients. And it changed the way client access to services. The fact that you have a different client access, client cost is something which is very important. It was not seen as that important because we tend to view bank as say fixed asset with it's a big building, you have many story, you have people inside, you have client coming in, coming out, but still you have an office. It's less solid than that. Client could move out, not visibly, but client could move, stopping to be with the bank for every operation, moving the operation to another bank, to another service provider, and just letting in the bank couple of activities, and then the young people can avoid to go to the bank and move to other providers. But that's other stories. So there are more fragility for the giants that we can think immediately. Something which is very very impressive is the fact that there is very low brand value in banks. You see on the top 15 brands shown by global brand, by Interbrand in their global brand recension. You have no bank in 2018. And you see the move, and the biggest brand are the brand of very well-known product, tech product, etc. And models from the net economy. But when you look at finance, the first one is Amex. And Amex is well known. They are doing a lot of publicity, but it's more a card company than a bank. The real first bank came 26. And the value of the JP Morgan brand is equivalent to IKEA. So it's not bad, but it's the biggest bank of US, maybe the biggest bank in terms of market cap of the world. So it's a little bit disappointing. And then you have the equivalent for each bank, and you can see that HSBC has also, like AXA, capitalization equivalent to a market capitalization of the brand equivalent to L'Oréal. So it's something puzzling to see the low positioning of bank there. And the challenger starts proposing service for free, and some of them have different strategies, and they want to offer services because they just want to reach scale, and then they will try to sell to existing bank, etc. But others want really to make a break, and they try for free with the idea to make the payment later, so that the freemium, so you have a free and a premium offer. That's something working not bad. A good example is Revolut. Obviously, the name comes from revolution, and Revolut was founded in 2014, so not long ago, by two young traders. They were working at Credit Suisse, I believe, and they were from Estonia, living in London. And they had one was living in Estonia, the other one in London. They were moving, commuting, and they had revenues in pound, in British pound, and they wanted to change in, I'm not sure that's a krona, but the currency of Estonia at that time. And they were just horrified by the cost of the foreign exchange commission of the bank. And even they were working at Credit Suisse, so they had preferred rates. And they realized that there were people working in London needed to change pound onto currency of Estonia, and also the other one having currency from Estonia and willing to purchase British pound. And they organize a platform, a marketplace, in order to do that and to match. And if you match, you have no cost. So it's no magic. It's just be able to do the match. And after that, it was very, very successful, because you can see the cost of changing foreign currency. At that time, it was 1, 2, 3%, 4%, even 5% of the transaction, and you propose zero. And London is a place where you have a lot of people. So it was very successful, and they developed other services, and then they developed a card, and they had a free option and a premium option. And they had problem because they were developing very, very fast, and they have an incredible target for a company which has not yet 10 years. They want to have 100 million clients, and they want to be launched in Asia and America next year. Let's see. But they have raised more or less 10 billion in equity. Here you have the table. It's a little bit dry and difficult to read, I suppose, on the screen, but if you have the support, it would be slightly better. But if you look at that, you see that the value of Revolut is quite impressive, because they are making losses. If you look at the net results line, it's minus, 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 minus. Obviously, a little bit less minus in 2021, which is only estimations of the close to what the management said. But they are supposed to continue to lose money. At the same time, you see they have a number of clients moving close to 20 million, and they have only 3,000 staff. So only 3,000 staff to have 20 million of clients. That's an impressive figure. But because everything is online, they are under huge pressure because the growth was too high. They don't know enough the clients. So they had a lot of compliance issues. So they will need to continue to hire people. Maybe they will reach very quickly 5,000 or 6,000 staff, but still. And the value of the company when they raised money in 2018 was around 1 billion. That was the figure of 1 billion is a mythic figure. A company being over 1 billion is a unicorn. They gained the label of a unicorn, and the specialized media, the press, look at the number of unicorn going in, out, etc. But you see, on the money they raised in 2021, it's an impressive unicorn, because the value is 30 billion, 30, and it makes a valuation totally crazy at first, because if you look not at the price earnings, they are making losses, but at the price on revenue, it's over 50. So it means any metrics like that is impossible on a normal life. It's just because the investor, it's not the market, the private equity investor, just think that the model will be successful, and they are pricing the development of the company until 2025, 2026. Maybe they will not reach 100 million clients, but they believe at least they will have 50 million clients, and that the client will upgrade and move from the free to the premium, and from the premium to the super premium, etc., etc. So you can build a story. It could be wrong totally, but that for the time being, that's the current story. So you see, with 30 billion implicit valuation, it means that if you go on a market, even making losses, which is possible and very possible in the US, 2/3 of the company going for IPO, introduction on the stock market, initial price offer, so going on the market, they are loss making. 2/3 of the company are loss making because you purchase growth story. So if that company goes on the market on the basis of 30 billion, you see if they raise money, they will have a lot of money to spend and to purchase and to develop, etc. It's a little bit early maybe now because they are still in a huge development process, but who knows? So that's the story of the say of the challenger, of the hard part of the challenger. And digital economy means also that you could force the bank to take a philosophy. Could the bank be a utility, a network, a pipeline, or so serving the client? A pipeline would be serving the client with different role getting in, and you will have a role from that supplier, another one, and the bank will just be the utility. Also, the bank will just wrap up the product, the different offers. So that would be mostly a utility, and a lot of bank hates that idea. The other idea is that bank should be a platform, and a lot of consultants say no. The future of bank is to be a platform. You will have a lot of third party within. You have your clientele. It's a little bit better in terms of value added, in terms of comfort for the management, because at the end of the day, the owner of the platform owns the client, and the share of the value which come back to the platform is better than the one going to the utility. The one thing I want to show you is that one. I will try to find the way to show you correctly that one. So I will share with you the video as soon as I can take the reference. So this is something which should be that one. It's on YouTube, so normally it should work. So let me check if I can share that video with you. Is it working? So
if there are billions of
so I will try to avoid the echo problem we had yesterday, and with that it should be okay. So let's go. If there is an echo problem, just let me know and I will change my setup. without any advertising advertising intention for the for new gen, but I believe it's quite interesting to see the the capacity of artificial or augmented intelligence to direct our choice and to some extent to facilitate our life coming from a bank. So if it's not the bank doing that, somebody else will do that. Obviously, regulation change. This is a video coming from 2017, I believe. And since then, the regulation on data sharing, at least on the West, was changing a lot. You saw the limitation than some of the big name of the web face, and I'm not sure it would be 100% possible without the explicit consent of the client. The only thing I would hate is to have my clock uh, moving the alarm from 8 to 7 or 8 to 5 without knowing it. But okay, I can imagine it's possible. But and even you can have even more say development than that. The well, one thing which is obvious is that the bank react, and a bank like J.P. Morgan mentioned that now close to 80% of their clients moved to the digital platform. So they had around 60 million clients, 49 million of them are working on the digital platform. And the main issue for them is why to have branches. Sorry, you see the in the video the branch was a no staff branch. J.P. Morgan continued to have 4,500 branches in the U.S. and they do not intend to reduce much from that number. They lowered the number from 7,000 to 4,500. Maybe they will move to 4,000, but for the time being, they say in branch they can have long discussion with clients, more detailed presentation. They can have expert thing, etc. discussion. So they, for the time being, they are still comfortable with that network. And they say a lot of districts in the US are district with minorities. When they say minorities, they are black people. Okay, in American English you say Afro-American, but that's black people. And so poor area usually with a lot of unemployment, social difficulties. So the task of the bank is to integrate more those people, and the CEO of JP Morgan is very vocal on that, saying he wants to open more branch also on difficult areas like those districts. But the population, the clientele is now on digital, so they didn't wait. And what they show, which is quite important, quite nice, is that the costs to serve, the unit cost to serve, obviously they don't give the full numbers, but what they explain is that the unit cost to serve a client, CCB is community and consumer banking, so that's really retail. The cost to serve them decreased by 15% between those on that period of 4 years, and that means that they made. If you decrease your unit cost by 15%, it means that you can reallocate resources a lot on other project development, and the cost reduced because they used to invest a lot of money onto the tech. JP Morgan has one of the biggest budget on IT because it's a big bank. The budget is big, but it's still impressive. It's above 10 billion USD, and they have something like a number of engineers or people working in software system, data management, data scientists, etc., which is impressive. JP Morgan claimed that they employ more than 30,000 engineers. But even a bank like Goldman Sachs, much smaller, much focused, they claim that they have close to 9,000 people working on such things. So the bank of tomorrow is already there. So bank didn't wait the fintech totally in order to react and to be on the market. Another idea that the maybe bank will disappear because if they are not aggregator of products, somebody else like Amazon will take the job. So the idea is a little bit like the bookshops. If you don't do the job very nicely, Amazon will take that. And by the way, Amazon will take much of the businesses. And if it's just a question to distribute, to deliver, why you need a bank? So that's a question, and well, you could have some debate on that. A tool to follow the position of the bank, which is very much used by, say, distribution companies like Amazon, but not only, is to look at the NPS, the Net Promoter Score. But this is the appreciation of the client, but this is only the intention of the client, so it's only part of the story. So we usually do not put too much emphasis on this measure because it's a measure which is a declaration of the client of its intention. It's not it's not the way he's going, that or she's going. It's the way he say. So he talk, he don't walk, in a sense. So it's only a very partial part. The good thing for banks is that they have for the time being the trust. And they have the trust because they are stable. We talk about, say, a fixed asset, they are there. The branch are an insurance to the fact they are still solid and present, so not an issue. I talk about the huge resources of the bank and the tech spending. You see the budget. Obviously, the budget in terms of percentage of asset is 0.5, not moving that much from a bank to another, but and it reflects the size and the of the bank. But JP Morgan or Bank of America, the budget is really big, and that should help them to reduce the cost in the future. So I have something on the CEO of, and it's also on YouTube. So normally I should be able to pass that to you easily. Normally. So this is the CEO. It was his first job of a CEO. He was a CFO, the former CFO, and he was the former the older CEO moved, and he started his job. But you see, that's officially on the results, and you see the important message is the results are on one thing, the quarterly result, but the most important thing is the strategy and the mission. He mentioned the KYC, and KYC is know your client. That's something which is a priority for the regulator, to be sure that the bank will not enter relationship with criminal organization, with fraud, with people try to launder money, etc. So it's quite important, and especially a bank like ING was suspect not to be strong enough on those topics in the past. But you see, the bank say they invent and they accelerate their digital process during the pandemic. The takeaway is quite clear. That there are challenges. The bank have moved through the regulator impetus in capital, liquidity, and risk management, reserve building. So it's more, the bank are more fortress in a sense now than they used to be. They are not as weak as they were before the crisis. However, they have now a big challenge, which is the fact that they have fintech, big tech. They have a lot of competitor. Bank service could be split in many pieces. So that's something which is an issue. And big tech is start to be really an issue. And a lot of banks complain about big tech more than fintech. Often banks can purchase fintech, and you see there is a regular flow of deal of bank purchasing fintech. However, big tech, that should be the opposite. Big tech venturing onto banks. You still have different regulation. US is somehow difficult for big tech. China was not, but since the Jack Ma and Ant Group, Alibaba issue, and the fact that they wanted to escape a little bit more from the national direction and want to have a more independent view on the direction of the company, the regulation is now quite strict on big tech and their capacity to venture on bank. The only place which is very free is India for big companies. So we saw WhatsApp launching services, Google launching services, maybe Amazon will launch services there. So let's see what happens in India. And India is supposed to have a very bad banking system, with only one bank being very successful, and the private bank, not the State Bank of India. And so let's see what could happen. But now the idea is that banks are more part of the solution. I put you a couple of additional reading, and there are couple of article, couple of video, and I choose to put you some video and some text reference. There is also something which is not bad about the refundation of banks. Bertrand Badré, who used to be the chief economist of the World Bank, published in Vietnamese 3 years ago, I believe 3 years ago, his book, which was is available in French and English. The original is French, Bertrand Badré, but the original edition was in English, then French. I believe it's in many languages, and he chose for a reason now I forget. I know Bertrand for long, but he explained me why he was publishing in Vietnamese, and now I forgot. Sorry, but the book, at least the book in French or in English, was okay and interesting, putting some direction on how bank can change to be adapted to the new economy and to save the planet and to face the climate challenge. So I believe it's a good book. No, in Vietnamese I don't know, but in original language, yes. So we move to the next station. The next station is about performance. Performance is a lot of the performance traditionally is with financial. More and more we tend to extend that to non-financial. But as we say very early, financial is very standardized. You have numbers, figures, standard setter, etc. ESG non-financial is not standardized at all. It's difficult to do that yet, and then it's quite complicated. And one thing which is something which is quite important in that is that maybe the market economy that we have known for maybe 200 years has entered a new chapter. All the evolution was made for the shareholders, and that seems logical. They bring the capital, but then the idea is that capital is not only the financial capital. Capital wealth is limited, and then you need to have the optimization of the allocation, the best allocation of that. But what we realize now is that nature is also a capital which is limited, that water, air, natural resources, that we have a limited that wildlife, anything which participate to the global balance of the world. And so because we have also a natural capital which is limited, we need to have a participation of the stakeholder. So a company is not sitting in the middle of nowhere, just investing money, but they have to take into account the natural resources that were given. So it means that we move from a market economy for shareholders only, because they bring the capital, they brought the capital, which is okay, to something which is a more enlarged economy on which both stakeholders representing different participation, different stake of the game, will also have a say in the process. And that refers to what is a capital. Capital is if you have a company making a net profit, we tend to believe that the net profit is good, and we don't see them linked with capital, saying, okay, we have a profit of 10, capital was 100, return on capital is 10 on 100, 10%, good. But the one thing is that if you have a company with 100 of capital and posting a profit of 10, at the end of the day, if the capital moves from 100 to 90, if that in market value, I would say, is that a profit? No. If you move to your capital to 100, from 100 to 90 in market value, in economic value, and that you show the profit as a reduction of your value, it's not a profit. Profit is the surplus you make maintaining capital. And the maintenance of capital is a very important concept for finance, but it's also a very important concept for nature. Because if you do not maintain the quality of the soil, if you are a chemical company, you use a resource which was supposed to be free until recently, but which is not. If you made a pollution, now you will have to pay. Now you will realize that you are using resources which are not for free. Obviously, it will take long before we'll have the full consequences of that. But maybe long could be more 10 years than 100 years. so which is a good news. So the measure of the performance should take into account that, and also for banks, and we should have both a long-term and a short-term view on the performance. Return on equity, you remember we say it's not very nice because leverage increase the return on equity. Return on asset is slightly better. Then if your equity reflect the risk, it should not be a big issue. You have also in bank an opacity of the revenues of the construction, the building of revenues, because you have revenues coming from the activity you have done 5 years ago and revenues from the activity you are doing today. So it's a little bit a mix, a bench of different things. The link with the business model is also important in the performance because banks are both labor intensive, we discussed that earlier, and capital intensive. I suppose now you are convinced that there is a lot of capital within banks. And we mentioned the net interest margin and the NII. A point I wanted to stress, we talk about loan margin and deposit margin. There is also the possibility to make margin because you play with the curve. So that's something which could be important. I doubt it's important in Vietnam, but it's just to mention it. The most important thing we look at after revenues is the cost ratio. And obviously cost ratio we discussed a little bit, but the cost ratio are quite important because you can follow business by business and bank with a comparable say benchmark, how they perform, and at the end of the day, it's very much a good indicator. And this is coming from the report made by the ECB, a regulator, and they track for looking at the cost ratio, the staff, the FTE, and they look at the branch number. So obviously, staff and branch number are the key drivers of the cost ratio. So if your staff is going down, if your branch number is going down too, obviously you should improve your cost ratio. But they are just short-term management rather than long-term positioning. It should be adapted to your strategy. And here you see that the cost ratio is only a ratio. So your cost ratio could move up and down, but also because your revenue or your cost is moving up and down. The cost ratio is cost on revenue. So if your costs are going down and your revenue are going down, you don't know exactly what is the direction. So be careful on the interpretation. Another ratio which is often computed is cost on assets, which is also a good indicator. Another way to look at the performance and to be quite focused on the strategy of a bank is to look at the performance or the revenue per product and the revenue per client. And it could be quite interesting if your client has many products to have both vision. For example, Standard Chartered, I have not the example with me now, but they reorganized last year, I guess, in order to show consumer banking and wholesale banking. And in consumer banking, they are looking at the deposit margin, the mortgage margin, the consumer loan margin. So they have a product analysis. At the same time, they have a country analysis, say China, India, Hong Kong, Singapore. So and inside each country, you can reallocate the revenue per group of client, per segment, and it can give you a very good sense of where the bank is profitable, where the bank has the right size, where the bank has problems, and internally it's also a very good tool. Obviously, you are obliged to make a lot of assumptions because a lot of the bank costs are generic, so you need to allocate the cost. But still, it's a good starting point. We talk about the importance of segment. if the bank deal with very rich people, wealthy people, obviously the revenue per client will be very high. If you work on the mass market, the revenue per client will be quite small. But because you have much more client on the mass market than on the private banking, you generate an amount of revenue which is not negligible. So here you have the split, the repartition of Nordea clientele. So Nordea is a Nordic bank in Europe, operating on a couple of countries, 5 or 6, and they have say above 3 million of what they call bronze, which is mass market purely, and then you see they have the amount of money they make on the different section. So it's important to know where you are, and banks use a lot this segmentation. So here you have a sum up of the ratio we usually use. You will find them also on the Excel spreadsheet we work with on the Lehman and Dexia. They are usually the main key ratio used, and you have the metrics which is adjusted for bank is to use the return on tangible equity. That's something we didn't tackle really. It's to say, we talked that in Basel I, and that's something we will discuss tomorrow. When the bank made an acquisition of another bank, if there is a goodwill, i.e. if the price paid is higher than the book value, so if you pay a bank 120 and the price is 100, then you have a 20 of goodwill, and this goodwill is deducted from your equity. And that's not for the accounting, but just for the regulatory purpose. So it means that your CET1 ratio would be computed on the total equity minus the goodwill. And total equity minus the goodwill is called tangible equity. And because tangible equity is close to CET1, and because CET1 is a very, very important metric for the bank, most of the people look at the return on tangible equity for banks. Obviously, return on equity is still an important thing, because if you pay a bank 120, you use the funds of your shareholders to do that. So at the end of the day, you use 120. So return on equity is still very important, but because it's not included in the CET1, that's something which means the ROT, the ROTE metrics quite important. So this is the thing on the ratio usage. I put you an example of a presentation of JP Morgan. You saw they even do not use ROTE, they use ROTCE, which is return on tangible common equity. So it means that they use a concept which is very close from the CET1. And that's the thing they had. So that the target CET1, what they call overhead ratio is a cost ratio. And that's what they want. They just guide the market with those three things. We had also a reference of a bank making recently a presentation, I guess last month, and they wanted to show that they were very efficient on the past, say, 10 years. And that was an investor day, and look at the ratio they were using. They were using the cost income, the return on tangible common equity, so the famous ROTCE, and they were showing the profits and the risk. And with that, with this slide, they are talking about their performance, how they develop, etc. But that's the basic of the metric. So it's not that sophisticated. What is sophisticated is to understand what is behind the numbers. So performance is a mix. Be aware that profitability is one thing, but solvency and liquidity is also very much imbricated with that. We need to understand the revenue driver. We spend a lot of time at the beginning of the lecture on the revenue disclosure and the thing like that. So it's quite important to understand that because it's a key of the business model. What sort of revenue you do, what is your client, etc. Then the rest of the performance metrics is how you perform it. But still understand first the business model of the company. So we more or less finish the presentation I wanted to do for the first part. So I will propose you to make a stop here and to make the break now and to start in say 15 minutes. So it's 10:20. It's 15:20 for you. So I propose you to stop now, and we will move to the session, to the rest of the session, looking at the merger and acquisition, which is our tomorrow topic, a little bit in detail. I saw that a couple of you are writing, so I will wait until I can see, I can read your messages. No, I cannot for the time being. Tram, is it okay to stop now and to start in 15 minutes again?
Yes, Professor.
Okay, so I will do that, and okay. So thank you for your answer, and see you in 15 minutes around. So 3:35 around. Okay. Have a nice break. Okay, should work. And I will start with the question on the slide 57 on the opacity that Tritron mentioned. Or maybe I changed maybe a little bit the. Is that one? No. It's. Okay, here, sorry. It was maybe 57 of the old pack and 58 of the new pack. What we have in most of the corporation is that they produce something. You have an activity during the year, and you sell what you produce. You have a delay, a time lag, so you have inventories. But in most of the case, your sales figure is what you produce at a quantity you produce, a volume, and you have an idea of the price in the different place you produce your product, and you can figure out what is the revenue. For example, a cement company, that's an easy thing. Well, relatively easy. Cement is a local product. It's still possible to export segment, but because it's very, it has a huge weight. The cost of moving, shipping cement is not negligible, so it slows a little bit the trade. So cement is a local product mostly. You know the quantity produced, you know the price, and you know what you have produced during the year, you know the price, you have the sales figure. So if you have 10 markets, you have 10 combination of the volumes and price. However, and that's the same, for example, for cars. A motor company produces cars. You know the different models. You know the price per models. Theoretical. You have discount to play a little bit with, to manage. But you have quantity. You have price. you have inventories, but normally those cars will be sold later on, so not a huge problem to estimate, and you can link activity to revenues. Here on bank, you enter a different sort of activity, and that's not only bank. That could be oil company, insurance company. With the fact that you use existing resources, you invest your resources, and with the investment in your resources, you have a production, and this production stay for a long period. In banks, if you make a loan, you don't take within your sales figure the net present value of the loan, i.e. the future margin, immediately in your sales figure. You take 12 months of interest and commission and fees, and you don't take 10 years. If you if bank were a car company, it's a little bit as if Toyota had all its vehicle produced at its balance sheet, and each year they will recognize a benefit for the client to drive the car for 1 year. So if for example, if the price of the car is $25,000, and if the car stays for 5 years, they will recognize each year $5,000. And the car will be at the balance sheet of Toyota. That's crazy, probably. But if you think about bank, it's a little bit what you have. You have the loans, and you within your balance sheet, and you recognize also only the benefit of having a loans 1 year, not the full benefits. Which means that within the revenue line, you have a mix of revenue which were linked to something you have done 5 years ago, or even 10 years if it's a mortgage, and the revenue of the year. So it's a mix of the revenue which came from the flow this year, and the mix of revenue which are coming from the stock, from the fact that you had activities over years. And that makes the analysis very complex. That's the same for insurance. And in insurance, you have also a lot of methodology to understand what is the embedded value and the appraisal value of the contract, specifically in life insurance, because life insurance is something which stays for a long period, where non-life, except liability insurance, is often very short term. But this creates a problem, and then you can have a huge arbitrage between clients. You can offer to new clients discounts because you want to attract them, and that the cost of the acquisition, but you don't have a cost in the cost line. You have the cost in the revenue line, which creates some mixage. Obviously, you can have that on a telco company offering discount for new client, or any industry like that. But the fact that internally you do product mixing, client mixing, means that even internally it's something very dirty to make the analysis safe. And often it's also very difficult when you are a bank to have the right categorization of your client. Maybe a client dealing with you could let you very small amount of money, but it could be in fact a very wealthy person and let you only a very small part of his wealth. So it means that for you, you need to make an effort to be sure that you understand that the client is a wealthy client, and for you it's a mass client, but in fact you could propose him more services, him or her more services. So it means that in banks, more than in other activities, you can do a lot of cross-selling, so cross-subsidizing. So you have profit leaders, loss leaders, and you can combine that under the same umbrella. And the price is not always seen by the client. When we look, when is that? No, it's not on that. When we look at the decomposition of the NIM, yeah, this one on the slide 16 now. Maybe it was 59 on the previous pack. You see, if we have the loan margin is something that a client understands well. You say my price is for this loan, consumer loan 7%. You know that the market rate is 5 at that time. You know that the margin the banker applied to you is 2%, and that's something you can, as a client, as an investor, you can easily understand. But as a client, you don't always make the analysis to say what is the margin on deposit. If the bank pay an interest of 1% on the deposit, you got the feeling that you receive 1%. But you do not often think that the bank is making money in replacing your deposit at a higher rate. So if it's that, it means that the client do not have the sense of the margin, the building of the margin from the bank. So it's a quite important question for the analysis of revenue, and it's not something very easy to do. And the one which is totally a shadow margin is the fact that often the yield curve, the normal yield curve, is like that. And in fact, long-term rates are higher than short-term rate. And if you collect resources short, and if you will make loan longer, you will make money because you just play with the steepness of the curve. Yeah. If the curve is flat, obviously there is no gain. However, if the curve is on a normal shape, then obviously you make money on that, and the client has no idea on that. And even for observer, outsider, investor, it's difficult to make a correct interpretation of that. And even internally, you need to make a definition of market price, internal market price. Yeah, you have a branch taking deposits. They pay 1% to the client. You have to fix an internal transfer price of that deposit to the treasury, and the bank, maybe the branch, will deposit this deposit at 2.5. So the margin made by the branch would be this 1.5, and then the treasury will use that to propose the money to another branch making a loan, and the other branch will make a loan at a different, etc. So you have to have a complex system of transfer price, which make it difficult, and the fact that you have so many differences here mean that both internally and externally, it's often very difficult to understand the building of the revenues. On the top of that, you have all the ALM activity, because we are just talking about the clientele businesses, but now the bank had a lot of liquidity. You saw the impressive move of HQLA, the high quality liquid asset we had in the LCR ratio we saw on the first lecture. And because of that, because of the investment portfolio, the bank had a huge amount of money to place to invest. And so this investment could have a huge impact on revenue too. Not that much on the building, but on the direction of the revenue, up or down, as a function of rates. Most of the net interest is provided by clientele, but the direction could be shaped by the evolution of the treasury components, which could be important. Okay, is that Tritram? Is that clear? Or should I develop? Okay. Okay, now if there are no other questions, we could be back on the M&A. Okay, M&A in banking industry is something which is like in any other industry with a lot of different rationale. And the most important rationale is that you believe that the company you acquire will benefit to your development, and that the association of the two is a good fit. Obviously, you have two sorts of acquisition. You can acquire a complementary company, something which is called often a bolt-on, something you add to your existing franchise, and it's not a game changer. It's not something making your bank a different bank, your company a different company. Imagine that you are an international bank. For any reason you want to develop, and you are in Canada, in US, and you are not in Mexico, and you say maybe it's a good idea, and you purchase a small bank in Mexico. That's not changing you as an international bank. That's adding you some new customers. Maybe the US customer you had were already trading, transacting with Mexican clients. So that's something okay. And then you have the transformation deals. The transformation deals are deals which are making you a different company. So you were doing just retail bank, and for any reason you have the opportunity to purchase an insurance company, and you want absolutely to do that. You do that, and you change the structure of the company and the DNA of your company. You could have many reasons to do that, but that's a transforming deal. And then you have the big deal. You have the mergers of equals, the big merging. You have two big banks, more or less the same size, merging together, and that could be for many reasons. That's the case for companies. That's also sometimes the case for banks. But often when the transactions are quite significant, it's often a good bank purchasing a bad bank. Uh, and this is at the time of crisis, when banks start to weaken a little bit. The temptation is not to purchase, because if you purchase a weak bank before a crisis, then you need to know that it's before a crisis, which is not obvious, and then you often don't know what will happen. So you know the story till you are running. So when things start to be a little bit better and visible, then you have the temptation to make acquisition of weaker companies. But that's normally should be the rationale. It's not always like that. So let's see the rationale specifically for banks. You have the scope. So we say you transform, but you could increase your range of activities. You are not doing that or that activities, and obviously you can build that. You can do organically. But organically, it will take you time, people. You need to hire the right people, and then you need to gain the client. So if you are not maybe dealing with a specific product in consumer, for example, in credit card, maybe it could be or better to make a joint venture with another company if it's not too dramatic for the bank to be in a joint venture, or it could be better to make an acquisition. Sometimes it's just because also you have the opportunity. Recently, BNP Paribas which is one of the big French banks, purchased a small bank called Floa Bank, and this bank is specialized a little bit in fractioned payments, so in payments by installment. So you purchase a good at a shop on the website, and rather than to pay immediately, you can pay in 3 settlements, in 3 weeks, in 3 months, but in 3 settlements on a short period. BNP Paribas is a big bank. They could have developed the activities and do that themselves. In fact, they choose to purchase Floa because Floa was available first, because the owner was a retail group, and the retail group was not so keen to continue to have that as a financial company within the group. And then BNP just believed that it will help them to gain some time. They wanted for a couple of months to venture on that activity. So they say, why not to purchase that? It's not a huge transaction. It's something like 250 million. And okay, they say it's fine. And now they will launch this bank with the same activity in other countries where BNP Paribas is present, Italy, Spain, Portugal, etc. So it's something which is helpful. Then obviously you need to be sure that the target, the company you acquired, is reasonably good, because if not, if you have to rebuild the company, it's also a waste of time. A key thing is that on the scope, is that activity integrated to your core business or not? Here, it's not totally integrated to the core business. So if the IT system of the target is fine, then there is no big issue, because on the long term you will link the IT system, no problem. If the IT system needs to be integrated immediately, that's another issue. Scale is because you want the volume, and you want to develop the activity, so you want to invest, but you want your investment in cost to be much lower than the investment of revenue. So you want to purchase a bank in your market. So if you purchase a bank in your market, you will have higher scale. We have currently 2 Italian banks discussing, talking. Unicredit is number 2 Italian bank, and based in Milano, and they are discussing to take over, to acquire a bank which is now owned by the state. So the state is not a good shareholder for a bank for long term in the West, and the bank is Monte Paschi di Siena. It's supposed to be one of the oldest banks in Europe. It was founded in 1472, if I'm not wrong, so a long time ago. And the bank faced a lot of difficulties for the past 15 years. There were a lot of issues, and the Unicredit offers the state to take this Monte Paschi di Siena in order to combine and to have a bigger scale in Italy. And then they will be present in a different region, because the Italian bank were very much regionals. So they will strengthen the position of Unicredit in the center of Italy, north of Italy. Italy is a country a little bit like Vietnam, with maybe 1,000 kilometers from north to south. I don't know if it's that's wide, maybe not as long as Vietnam, but the south is very poor and the north is very rich. And the bank tend to be located in the north, and they developed also in the center. Rome is a political capital based in the center. So this will create a stronger Unicredit, but then the idea is to have the all the system of Monte Paschi di Siena of MPS integrated in UniCredit, and to, in fact, even reduce the total cost bill. So that's something which is quite understandable. Then you could have market power. It's something which is less legitimate. You just want to be a nice oligopoly, and you want to exclude all the other small players. You want to be one of the top 2, 3, 4 banks, and not sharing the profit with anybody else. So you will be quite free to set the price where you want. So then here somebody should say no. The somebody who say no to that market power is a competition body. The name could change from one country to the other one, but it's an antitrust, a monopoly, a competition. So you have different names, but at the end of the day, it's a public authority, normally national, but could be supranational, like in Europe. We have a European one and national one, depending on the size of the businesses. And this authority can say no. You cannot merge, because it will create a too big company with too much market power. So obviously you can try as a bank, like as a company, to have that, but it will be prohibited. It will be vetoed by this antitrust authority. So it's something that the bank, as other company, could desire, but if it's too concentrated, then the answer of the authority will be no. And in couple of cases, the antitrust say no. Even recently in some payment activities, the antitrust say no to a bid of a US company on a UK company in payments, because they would have been too big worldwide, and they would have had a dominant position. Then the question is, you have a dominant position, but what is a relevant market? If the relevant market is only bank, or in our case, then obviously the antitrust has a lot of power. But if the relevant market is bank, fintech, non-bank, etc., maybe a merger of 2 banks makes sense and could be authorized. So there is a lot of issue on a key question, which is, what is the relevant market? And it looks quite easy. It's not easy, and you have a lot of discussion about that. And you could have, for example, a bank with a dominant market share at a regional level, but not at a national level. So if the regional level is taken into account, a merger of 2 banks which are important at regional levels themselves will create a super monster, super big bank regionally. So if it's that, normally the antitrust should look at the regional level and say, no, you will fix the price at crazy price. The banks say, yeah, but the people could shop around. They could go to they can go to fintech, to the web. So then it's an assessment of what is the capacity of the client to move away from that and to be independent and not too much price dependent from banks. So then there is a lot of things behind that. Then obviously you have management powers. Management loves to be visible, to be big, and then bank is a good area for that, because it's often close to political circles. You have a lot of movement between bank and administration, and it's something which is very much the case in US, but in US it's more the bank people going to the administration. you saw that a lot of the people from the treasury, for the Fed, for the economical advice of the of Trump and Biden and even Obama, were coming from banks like Goldman Sachs, J.P. Morgan. So they are smart people, they are good experts, and they are going to administration. Obviously, they are losing a lot of money because they are putting an end to their very successful career at investment bank or large commercial bank, but the movement is there. In Europe, it tends to be the other way around, moving from administration to banks. That's more the case for France, England, um, Netherlands, some of the Nordics, but it's less the case, for example, in Spain. You have less movement like that. It's less natural. So it depends from country to country. I don't know for Vietnam for sure. And then the other one, which is very much related, is the ego of the chairman. It's a fight to be number one, but it's also the fight to be the darling of the market. To be the darling of the market is to have a good valuation. And to have a good valuation is often something related to the fact that if everybody is doing acquisition, if you are not doing acquisition, at a certain time, you look stupid. So a lot of banks were venturing onto acquisition in Europe, starting the creation of euro. The euro, the common currency of Europe, was created in 98, I guess, and was implemented officially in 2000 or 99. And starting that day, the banks start to merge in order to prepare for a common market, a bigger market, a larger market. And there were a lot of development, and one of the development was to extend to Central Europe for Western Europe bank to move east. And to move east was to purchase banks which were, say, often in the past managed as a state-owned entity, because this part of Europe was under a different economic system. And because of that, it was somehow tricky, and some banks start late 90s to purchase bank in country very close like Czech Republic, and then they venture a little bit far, and so they were. This was viewed by marketers very wise. East will integrate it to West, and then that's the source of growth. So it's natural and legitimate to purchase bank. But market was underestimating the risk, the difference of culture, the difference of system, the link with political organization. And because the system were not working exactly the same, most of these acquisitions 10 years after turned to disaster. Not all, but a huge part of them. And so it was quite painful for banks not to do an acquisition in Central Europe in 2005 or 6 if they have done nothing before. That's, for example, the case of BNP Paribas. In 2005, after listening to shareholders, to big investor telling BNP Paribas, you have to invest, you have to invest, you have to invest, talking to the CFO, talking to the CEO, being vocal. At the end of the day, the board of BNP Paribas say, okay, we can venture, and they choose something very bad. They choose a bank in Ukraine, and the bank was explained as a good bank. The central bank governor was questioning. He was telling the story. BNP got the idea that the bank was not perfect, but that they have the capacity to help the bank to improve and to become a good bank. And 4 years after, they paid 1.5 billion euro, more or less dollars, and 5 years after, that was 2005. Yeah, in 2010, the value of that company was zero, more or less, because Ukrainian economy was shocked and hurt by the crisis, but at the same time, also because the bank was a fake bank and it was a very corrupt bank linked to politicians' personal story, personal wealth, with a fight between people, etc. It was an empty shell. And BNP, when I say the value was zero, they reinvest in, they still have a stake in today, but it's a disaster. But it was that because in fact, the pressure to invest was such that they couldn't resist at that time. So that's part of the ego, but that's also the market pressure because you want to be still very good. So there is something which is very specific to banks. We discussed that twice already, but I believe it's very important for your understanding of the M&A case. Goodwill is so the difference between the price paid and the accounted value purchased. So you purchase 120, the value is 100, you have 20 of goodwill. Okay, that's easy to understand. At the time of acquisition, you have to say, is the value of the 100 of the book value of the bank I purchased really 100? Then in some cases, if the bank is in bad shape, you can say, no, the real value is 90. So my gap, my difference between the price I paid, 120, and the value I receive, 90, is 30. And you depreciate the book value because you say this bank is not as strict, as conservative than me on the ways they recognize provisions. You remember in risk assessment, there is a huge part of judgment. So two systems of two banks facing the same event will give slightly different answers. But the slide could be bigger if the bank is really in bad shape. Maybe they just underestimate the provisions. So that could be that. That could be tax. That could be the fact that you need to put the IT away and to change the IT. And if it's that, you could have a recognition of the fact that the value of IT, but then you need to have a value of IT in the asset as an intangible asset, and then you have to reduce those asset value to the amount you believe it's reasonable. Then your auditors have to put a stamp on that. You cannot do anything alone. And then you have this new value, say 90. So you have this goodwill. So this goodwill is deducted. And why is this goodwill is deducted? So this is a small pool. And the question is why the goodwill is deducted. I will propose you a couple of because I will propose you a couple of answers. On the doc. I will propose you three different, and with a possibility not to answer to. Oh no, I will One of the answer is okay. So why the goodwill is deducted from the equity? Because it's non-cash, because it's future profit, because it's future losses. Okay, I will stop the poll now. Okay, thanks to be brave enough to answer to this stupid poll. It's not stupid, you will see, but it's quite difficult, and I apologize, but I want to put you in a difficult position to answer. Obviously, the goodwill is not a cash item, but the amount you pay, the 120, is the amount in cash you give to the former owner of the bank you acquire. So if the guy give you the keys of the bank, you give him or her 120. So you give him in cash at some point. So it's not because the goodwill is just the difference between the two. Why you pay a bank? So that put us on the question: why you pay a bank at a higher value than its book value? Because that's what we say at the very beginning of that section, because you believe that the combination of the two will produce a better bank. A better bank is more profit, more growth, so future value. So it means that goodwill is normally a reflection of the future value you expect to deliver during this combination. So I'm sure it was not intuitive and not totally clear. So it's because it's a future profit, and the if the regulator say to the bank, okay, that's future profit, I'm comfortable with that, but then the regulator say, hey, wait a minute, I do not want part of my regulatory equity being made with future profit. What I want you is to have equity facing present losses. How I can match future profit and present losses? It's impossible. So if you have future profit in your capital, okay, that's your problem. It's not mine. I do not want future profit in order to face today losses or today potential losses. So present losses should be faced with present equity. And so that's the main reason. It's because it's future profit. And if you pay 120 something, which is 90, the future losses, the situation where you are not comfortable with, you change that from 100 to 90. It could be 100 to 40 if you really believe that there is a lot of doubt, and then your goodwill will be much bigger. But then you will have to deduct that from your equity. So you see, this is something which is a big issue in bank merger and acquisition, because it means that it's immediately, it has a cost on your capital, on your equity capital. Because if you make an acquisition with a big goodwill, immediately you have to deduct it from your capital base. So imagine that you have risk-weighted asset 100, you have equity of 10, perfect. You have a ratio of CET1 10 on 100, 10%. If you need to be above 8, okay, we know that's not really the story. It means that you could swallow a goodwill of 2 before being non-compliant. But you cannot take more than 2, and even 2 is not very safe because you need to be a little bit above the border. So maybe in order to make an acquisition of 2, you need to be maybe at 12 or 13 or 14. So you need to have more equity. So the main issue with that, the main lesson is always remember that goodwill is deducted because goodwill is an estimation by the management at the time of the acquisition of what could be the future merits, the future benefits, the future profit. And future profit cannot face today present losses. Only present equity, present earning could face present losses. Yeah, so this is quite important issue on banks, and that's why regulator are very strict on that. Obviously, that creates an incentive, sorry, to make acquisition with shares. So if you make an acquisition with shares, it means that you say to the bank W you want to acquire, okay, fine, I will purchase you at 120, but I will pay you 20 in cash and 100 in share. So then you made a capital increase of 100, meaning that even if your goodwill is 30, you will in fact increase your equity by 100 too. So it means that the goodwill is no more pressure on your capital. Then the big question is, are the shareholders of W happy, of Bank W, happy to receive your shares in exchange? You know, a lot of people would just prefer cash. So what happens often is that you have a mix of cash and shares in bank acquisition in order to alleviate a little bit the goodwill constraint. Okay, so we'll close that. Okay. Sorry. Is that clear? Because it's and I'm a little bit sorry to put you in such difficult points with the poll, but I guess it's still a good thing to do at this stage because the answer is not intuitive at all. So if we go now, if we dig a little bit more in the rationale of M&A in banking, the one thing we have, the most important thing, is often the cost synergy. And that's the one the investor purchases. The investor are comfortable with cost synergy because, oh yeah, okay, sorry, Tran, yes. Yes. Yeah, the B is effectively the one, but I apologize because I recognize it's not at all intuitive, and especially on the way I put the question. So I didn't give you all the keys to answer fully, but it was a little bit a pitfall, but it's to impress you and to show you to put that in your memory. I apologize again. The most important thing on the rationale of M&A are the synergy. You have two categories of synergy. You have revenue synergy in the combination, and you have cost synergy. The one investors follow is usually only the cost synergy. We'll discuss revenue synergy later. But the cost synergy are in fact quite secure because it's an internal game. The bank A and the bank B will be tomorrow in the same umbrella, in the same organization, and you can recombine the two banks the way you want. So if you say, I will have only one HR, one accounting, one credit department, one organization here, I had two branches next door each other, I will just have one branch. So you take, or normally you look at your branch position and you say, okay, I have 1/3 of the branches which are less than 1 kilometer or less than 1 3 kilometer far from each other. So I will merge the bank, reduce the cost of a branch, and serve the client with an office more or less as convenient as the other. Maybe you can even lose some revenue during that. And but at least the cost is something certain. We will discuss revenue later. So you have all the capacity to do that. Obviously, revenue synergy, which is our second point, is much more difficult because it's a different product or different client, and it's something much more difficult to imagine. So generally, as an investor, we can tend to look at the potential for revenue synergy, but it's something that investors prefer not to take generally, but they can look at the value, at the theoretical value of those revenue synergy, and not include them in their computation of the value of the deal, but to have that as a side computation, just to think a little bit more on what the bank will deliver. And if the bank deliver, maybe they will include that later on. But then you need to give investor some proof that it is working. And you could have, so what we say, revenue dis-synergy. A famous example was a merger of Commerzbank in Germany and Dresdner Bank. Those two German banks had a diverse clientele. They have retail operation, they had SMEs, they had a large company, large corporate as a client, institutional activities, asset management, etc. So insurance. So they were big banks. So they merged, and in 2008, not the best time for merging, but that's explained also why they merged, and they were more or less forced to do that. And they had, in fact, in large clients, a lot of common clients, and those common clients say, no, we choose by purpose to have Commerzbank and Dresdner Bank and other bank in order to split our business onto different banks. If Commerz and Dresdner merge and become only one bank, we will reduce by 50–60% our activity given to that bank. So they lost at the end of the day something like 10% revenues, not from only those large clients, but from other, say, large mid-sized companies. So they had a dis-synergy, a reduced synergy in revenue, which was very visible. Sometimes it's just a small number, 1%, 2%, not very visible, and sometimes it's very visible. But in order, the other concept, very important, the other thing to do, to achieve, to deliver the synergy is the CTA, the cost to achieve the synergy. The CTA is in fact a cost which include all the measures you have to take into account if you want to combine the bank and to reduce the cost. If you want to do that, you have to offer the people to leave the bank you have to pay them to offer an incentive, or depending on the regulation, you have to lay off and pay with maybe 2 years of salary, 3 years of salary, if they want, or it's often optional, or if it's in wild areas like US, sometimes you can say, no, I fire those people and I give them 6 months of salary and they have to leave. Well, even now it's less wild in the US than it used to be. And then also you have to depreciate the IT if you move from one IT system to another IT system. In the US, it was one of the big facilitator of the M&A, the fact that most of the small or mid-sized regional banks operate on an IT system which is not in the bank, but which is a platform. And the platform operates many banks. So you have a couple of dozen of platforms, but if the bank were on the same platform, it was very easy to combine and converge the information system because they were in fact managed by the same suppliers outside of the bank. So it was so easy to do that. That was a very, very limited cost. However, if you are a big bank with an old system, moving from one IT to another one is a big issue. And often a very bad solution is to say, I take the IT of bank, so I'm bank A, I'm purchasing bank W, and I take the IT, a new IT, and not the A, not the W. That's normally a recipe for disaster. Because if you try a new one, there are so many new things that you could lose your expertise on both old system and the new system could be problematic. A good example of that was a Spanish bank called Sabadell, and it's a known it's a known company. So why I cannot enter to the institution? And they had purchased a bank in UK which is called TSB, and this bank was in fact a subsidiary of another British bank, but they were obliged by the antitrust commission to dispose that bank. And so Sabadell purchased the bank, and in the contract, Lloyds Bank, the former owner, say, okay, we will provide you our IT system for 2 years. Good. But in 2 years, Sabadell was not able to develop a new system which could be fitted for TSB. And they tried to adapt the Spanish system to the UK environment, but unfortunately the products are not exactly the same. I don't know, for example, if a bank in Vietnam wants to develop in Thailand, maybe the mortgage product, the consumer loan product are not exactly the same. The regulation is not the same. The clientele has not the same behavior. So maybe it would be a huge task to transform that. And at the very beginning, Sabadell was very confident that they will use their system. So they tried to use their system, but their system failed many times and they have no plan B. So during 3 months, there were a lot of breakout of the system. A lot of clients were outage of the failure of the system, and some clients were unable to access their money during 3 days, 4 days, 5 days. So it was unacceptable, and TSB was fined for that, and they have to compensate clients. But it is a very nice example of failure in IT, in moving IT system. So the CTA, the cost to achieve, is supposed to be the cost, all the cost linked to combine effectively the operation of the two banks. But this cost, you see, is a very nice thing in the analysis because it's a one-off. And often it's split or spread on 2 years, 3 years maximum. So if a bank is doing the acquisition next Monday, 11th of October, then maybe most of the spending will be on the rest of 21, 22, and 23. And then after that, you have no cost. You have all the benefits of the merger, of the combination, and the cost will come back to zero. So it's a one-off. So in the perspective of the appreciation of the deal, the benefits will be permanent, the synergy. So that will increase the revenue line on a permanent way, on a perpetual way, whereas the cost to achieve is a one-off. So if you have a gain, for example, a synergy, a cost synergy of 200 permanent, and a cost to achieve of 500, it's not a bad deal, because the 200 of cost synergy will be forever. So we try, imagine that the valuation of the bank in your country is 12 times. So it means that the 200, you will value them after tax, but we forget the tax for the time being. You will value them 212 times, which is quite nice, because 12 times of 200, that's 2,400. And in front of that, you just have 500 of cost to achieve. So net, the gain will be 1,900. So it's still a net, it's still a very nice operation. So you cannot compare directly the 200 with the 500, because the 200 are perpetual, where the 500 are just one-off. Yeah. So that's also something very important. So when you compare the value added of a transaction, just think about the value of the synergy, the perpetual value of the. So I put the, I just view that I put wrongly the name of the Spanish bank. Sorry, it's Sabadell and not Sabel. And so to be back on, when you appreciate a combination, a benefit of a merger and acquisition, you have to think about, okay, the value of the synergy on a perpetual basis. So then we use a price earning, usually as a shortcut, and then you deduct as a one-off the cost to achieve the combination. So you have some example on how work. So I don't know if the chart is very visible, but it's a chart coming from the ECB, an ECB recent publication on the merit of the mergers in Europe. They because ECB want to have more bank merger in Europe. It's they believe there is no such thing as European banks. Sorry, and they want to show that it is efficient. You see the cost ratio after acquisition, the what they call CIR, cost income ratio. It's moving up, and then after the second year, it's moving down sharply. That's the same if you take another ratio, which is the cost on asset. We discussed the merit of the two. Here you see that the cost of asset is a little bit more, looks smarter because you have not the revenue impact. And you can see that both return on equity and return on assets increase. Return on equity, it's possible because it depends where you take the money from. Imagine that you have a lot of cash yielding 0. You invest in another bank and you have enough liquidity, etc. But you just redeploy money in the transaction. Then obviously, automatically, you increase your return on equity. The one thing that the consultants say pay a lot of attention to, and I'm not sure it's very easy to see that from the slide, but maybe from the deck you will have more facility to look at. I guess it's coming from a SocGen presentation, and it's a McKinsey report, to say that the more you do the merger and acquisition in a country, in fact, domestic operation increase the scale, and because it's increased the scale, it gives you a lot of leeway in order to improve the return on equity. So there is a correlation that what you have on the right part of the chart with the market share and the return on tangible equity. So this is a consulting job, so you can always challenge and discuss it, but it's still something. I believe it's a McKinsey job somewhere. but it was quoted by SocGen, if I'm not wrong. So it's something which is a consultant affirmation, but it's also something we can easily backtest, and it seems to work in most of the cases. But there are a lot of risk in merging two organizations. You don't know if the DNA is compatible or not. You can have a bank where the best paid people are the commercial. Another one where the best paid people are the risk managers. Another one where the best paid people are the legal people or the IT people. So you can have very different culture, and or traders could be the highest paid people. So if the highest paid people is still a reflection of where bank put the talent, and the talent still give an indication of where you put your values, and that's still an information interesting to have, and the culture are not always compatible. The place where you have most risk are hostile bid. Hostile bid were things which exist in the US. US is supposed to be quite wild for a long time. And in US, in the 80s, there were hostile bid, say, coming, the bid were fueled by asset managers. Asset managers were not pleased at that time with the bank performance. They believe it was too comfortable, too pedestrian, that the banker was sleeping beauty, and that they were not making the job. So, couple of investment manager, principally based in Boston, signal start the revolution, and they push the bank to question their value, and they put a lot of pressure on a group of young bankers in order to do the acquisition of the old one, and there were a lot of wave of hostile acquisition. And US is US. That was mostly working well because the people were good bankers. They were selecting sleepy target. So it was inefficient. They turned to be efficient. That's the market thing. In Europe, it was not common until I would say late 80s, beginning of the 90s, and there were very few operations. One big operation was made by Royal Bank of Scotland, a small Scottish bank, very aggressive. In 2000, they purchased NatWest. NatWest was the old lady of UK banking, National Westminster. So NatWest was really an old lady, and the old lady was not sleeping totally. The old lady was moving, but at a pedestrian way. But the strategy was quite good, and the bank was very conservative. The bank was viewed by the market as a very bad bank, so the price was down, and Royal Bank of Scotland made an hostile bid. And so because NatWest was very conservative, in fact, and was a good bank, but not visible totally from outside, then they made the hostile bid was okay, because when they opened the drawers, they opened the doors, and they found a lot of very good things. So it's reinforced the idea in Europe that a hostile bid could be good. So the one thing is that you have a limited set of information on the bank, which is not given officially. So obviously at that time, Royal Bank of Scotland asked everybody in the bank who had relationship with NatWest to give back information. And they find quite a good image of what was in the book of NatWest. But that was only a partial view. And so that's why you could have different culture. You could be aggressive, conservative. So that could be an issue. Then banking is very cyclical. What we said about Central Europe before is that in the cycle, M&A is very cyclical. So if M&A is cyclical, it tends to be bigger in bank as in other sector when market is up, and the more market is up, the more you are tempted to do operations because you think wealthy, you think well, and you have say rosy glasses, and you look at the world with a fresh view, and you say, okay, today is very nice. So you tend to have a boom and bust cycle, and that creates additional risk at the verge of a recession. We mentioned that the key issue is the IT system, that's for sure, and the other thing is to understand well who is the important people who are the important people of the bank you acquire. Because if you miss if you say fire the people which are the key people from the bank you acquire, you will lose history, the capacity to manage the bank, etc. So that would be quite a bad thing. Well, you could do joint venture. This is again McKinsey. You see, M&A is an area where the consultant has a lot of things to tell, and this is a McKinsey to say that if you share the thing, you can gain point in cost income ratio or cost ratio. So you have the IRAs saying if you share the front office, if you share the IT, if you share the marketing. So you have a couple of ideas of where you can do things on joint venture rather than doing merger and acquisition if you want to do something lighter and not too traumatic. Here we say that there is a wave of merger and acquisition. You see in terms of value, you have a number on the right side and value on the left side. In terms of numbers, there were a lot of mergers. This is Europe. You have a lot of merger at the end of the century and less now. But if you look at the value, you see that the bulk of the value was 2000. The peak was 2000, say 5, 6, 7, just before the crisis, and then you see the gap. You have in yellow the domestic one, and you have in blue the cross-border. And you see the cross-border wave was really 2005, 2007, which is quite bad in terms of timing, because most of the problem occurs in 2007, 2008. So it just at the last moment that the bank were making the riskier operation. That's history. That's life. Okay, that's the bank. So one thing we look at when we look at the valuation, I'm sorry because the graph is a little bit difficult to read, is you have the return on equity. You can put a return on tangible equity, and you have what they call price book value, but it could be price tangible book value or tangible equity. And you see that there is some relationship, not always perfect, but there is some relationship between the price you pay and the return you get. So there is a logic behind, is that the more the bank is profitable, but it has to be sustainably profitable. If it's profitable just 1 year, at that level, it's not a huge value. And then if the bank is that profitable, maybe the bank deserves a value of a price tangible book, which is at that level. And if your return is that, your price should be that. So it's often this mapping is often used by investors to say, okay, you are a bank with a return on equity of that, your valuation on the market should be that. We are not, you should not use that as strictly as an indicator, but it's something which could be useful to look at. Another way to do the valuation is to do it through a sum of the parts. A sum of the parts is to say, for example, you have a bank like HSBC, a big bank, but you have a part in Hong Kong, a part in China, a part in India, Singapore, another part in Middle East, another part in UK, another part in US, etc. So you can make a valuation of the different entity on a separate basis, then aggregate all together, and then produce a combined value of that. It could be by geography, it could be by business. If you take UBS, you can say UBS is a Swiss bank, UBS is an investment bank worldwide, and UBS is a wealth management bank. And you can combine the three and to say, to apply some metrics to make the valuation of each of the business and to say what is the value of that combination for my shareholders. But it's an analytical tool. It's not bad, but it's always something very subjective because you use different metrics to different businesses. So it has some appeal because you use a metric adapted to a business. For example, for wealth management, maybe you can forget the valuation in terms of revenue, in terms of profit, in terms of equity. You can say, I manage that amount, say $2 trillion. If I manage $2 trillion, I know from my market research that a wealth manager is valued normally 2% of the fund. It's not something you can take directly at UBS because UBS has three businesses. But if you look at pure company, the pure company the valuation is 2%. So you put that valuation on the wealth manager. You do the same for investment banking. You say Goldman Sachs, Morgan Stanley, and even Morgan Stanley is not a perfect one, but you say those banks, the valuation is that, and you take the metric. And you say a Swiss bank, the valuation is that, and you take the metric. And then you combine all the things. But it's often something with limits, and when people try to use that, it's more to justify a decision, a purchase, and that's often a tool used by brokers in order to persuade bank to look at a target and to say, look, this bank is very attractive for you because you have that. If you make that acquisition, you can dispose the Swiss bank, you don't care. So purchase UBS, okay, that's a very theoretical example. Purchase UBS, sell the Swiss bank to another bank, to the maybe co-op bank, to the mutual bank, and then you keep the investment bank and the wealth management. And because you sell the Swiss bank for, say, 5 billion, your price, your acquisition price is much reduced to that. Because in an acquisition, not all the businesses you purchase are related to the combination you will pursue in the future. So that's also something quite important. So here, for example, you have Citigroup. Citigroup have two businesses, consumer bank and investment bank. And you can see that the ROTCE of the two divisions could be quite different. So you have the return for 2020. You see the return of the consumer bank is very low. The return of the investment bank is very good. Citigroup say, yeah, but it's a diversification. But then you can say, maybe what is the link between a consumer organization and an investment bank? Why not to split that? So I made a bid on Citi. I sell at the best offer the consumer bank, and I get with the investment bank, or do the opposite if your interest is the opposite. And you can enter in such thing. So the class, the lecture is maybe finished here. So if you have questions, feel free to raise question or to raise your hand. But if not, we will finish here our two-day lecture. We will start tomorrow morning. There is still one point I need to mention you is the K coefficient. I will start with that tomorrow morning. And you remember that before tomorrow morning, sorry, tomorrow beginning of the afternoon, and tomorrow beginning of the afternoon, you will have to finish this small exercise on mortgages. And then that's the reason why we'll discuss the K coefficient at that time. I will ask Tram how many groups were created. I believe that there are 5 groups, but I'm not sure to pick the right number because on the chat, I believe, yeah, Tram mentioned me at 909 that there were 5 student groups. So if there are 5 student groups, I will give you 5 cases for each. If Tram confirm me the number, and you will have a practical case, which is the slide show the presentation that the bank made in front of investor at the day of the announcement of the transaction, in order to persuade them that it's a good transaction. So be careful that the acquiring bank explaining the transaction. So they will not tell you it's a bad transaction. They will tell you it's a good transaction. So it's a little bit of propaganda, but it's educated propaganda because there are rules, there are public investors, there are public banks. So you cannot just say stupid thing. So you have to say articulated things, but be careful that the person making the acquisition explaining you the story. So I will provide for each of the cases some background information and how to use the slide in order to make sure that in 3 hours you will be able to produce something as a combined group. But I advise you to work, but oh no, we will discuss that tomorrow morning. Tram, I don't know if you are still there or not. I'm not sure. If you are in, maybe can you confirm me that there are 5 groups? Okay, not sure, but okay, Tram will confirm me the number. So if you have any question on the M&A section specifically, or on what we saw on the past lecture, feel free to start with tomorrow morning. We could have 15 minutes on that, or 20 minutes, not much, because I want you to have most of the time on the cases. And so enjoy the rest of the afternoon. No, I will not close because you still have comments. So I will explain you the requirement. You mean the M&A case? Yeah. So, but it's difficult to understand because I haven't given you yet the cases. You will see. We'll discuss that tomorrow. We will take time in order to present you the cases and what you have to do. So you are right. You are writing. So I will wait. I see you are writing till. I'm still waiting because I see that a lot of people is writing. Yeah, I will pass you the cases. I will send the cases to Tram, and she will pass the cases to each of the group as soon as possible. So you will have them ready tomorrow morning for you, but morning for you. And the requirements will be explained. So you will have to make some computation. So we will take time to do that. So the exercise will be sent to Tram, and then to each of the group by tomorrow your time. So it will be so you will have that tomorrow morning your time, not my time. Okay? So if it's so no. Okay. So have a good end of the afternoon, and see you tomorrow afternoon. Cheers.